All right, Dom. So welcome back. We haven't done a call like this for several weeks, so I figured it's time we do another video.
Yeah, it's been a little bit.
Yeah, how have you been?
Doing well, trying to stay cool. We're in a heat wave here in Philadelphia, and I like my air conditioning. So hopefully I'll be able to stay cool this weekend with the 90-degree weather. So
And how's the baby? She's sleeping?
sleeping, yeah, she's good. I'm no longer sleeping on a recliner. I was on a recliner from the most of June, but she's back to sleeping all night. She's great, and she's rolling now too. So that's going to be a lot of fun when she becomes mobile.
Good. Yeah.
Yeah, yeah.
I'm a little tired this morning. I know last night we had our semi-annual market update here at the office. We had 25, 30 clients in a room.
Yep.
We do our presentation on where things have been, where things are going from the market perspective. And it was a good night. And it was just a late night.
Oh yeah, yeah, yeah. It's a lot of good material there. I mean, it's been what a pretty boring market though this year. Not much news has gone. Low. Tell me about it, right? I mean, what are we going to talk about?
We had nothing to talk about last night. It was the most boring market update we ever had. It's probably one of our best attended ones. But as much as we love doing that, much as we love maybe having a beer afterwards and talking to people, we only had 25, 30 people. That's only a small percentage of our client base. So
Yep.
probably a good idea that you and I do this video and get it out to everyone so they can see and hear what's going on. So yes, very boring year. Not a whole lot to report. If anything else, right? It's definitely been an interesting year. We're clearly in a bear market. I think when we did this last video, we were just short of a bear market.
Yes.
And now we are technically in a bear market. So there's no denying that.
Yeah. So the main theme of last night, I think, was a little bit of what's happening in the stock market, the bond market, which I know we'll touch on a little bit later, but really it was inflation. Tell me about it.
Absolutely.
It's been low, right?
Yep. Yeah, so inflation, we knew we were saying this middle of last year, second half of the year, in all of our review meetings,
Yep.
inflation is going to be going up. We're going to get
Mhm.
higher inflation. Now, we were a little surprised by how quickly and how rapidly it went up, but we knew it was coming. We saw the December numbers. We got those in June, when the inflation was up about 7%. That was more than we were expecting. Things kind of stabilized, and then we had the war in Eastern Europe between Russia and Ukraine, which many people may not realize had a massive effect on inflation. That had a massive effect on global energy prices. Energy is a global commodity, and whether there's a war halfway around the world or in our backyard, it's going to affect global commodity prices, especially when one of the participants is one of the world's leading oil producers.
Yep.
So we saw oil skyrocket. We see our gas prices skyrocket. It's happened throughout the entire world. There's not much you can do about that, but it affects everything, from prices that we're paying at the pump to prices to move your product from point A to point B,
Yep.
from creating petroleum products like plastics for packaging. It
Yep.
goes into every aspect of our, our economy. It trickles down to every aspect of the economy and really has an inflationary headwind for us.
So in May, we had an 8.5% inflation number on increase to CPI. In June, we saw that to be 9.1%. At the end of late last year, I think we heard a lot of different investment managers and economists kind of say that inflation is transitory. Turns out that that hasn't quite been the case yet. But when we think about those number 8.5 and 9.1, what really made up that? I mean, I know you touched on oil.
Mhm.
Is there anything else that really makes that, we break down when we think about inflation?
Yeah, it's been migrating through the year, but really where it is right now, the May 8.5% inflation number we got. Of that, Moody's is estimating 5.5% of that 8.5 was either the war in Eastern Europe and its effect on energy prices,
Hmm.
as well as COVID and the supply chain issues that we've been working through for a couple of years now. We started to make progress on that end of last year, but then you move into 2022, we get another COVID outbreak in China, and they shut down Shanghai and some other major shipping and
Ports.
manufacturing areas that feed the whole world. And all of a sudden, we're back into a supply chain concern again. So those are the main things. We're not going to see inflation come down until we see energy prices come down and the supply chain start working its way out. In June, the June number at 9.1, one additional factor that got crept in was housing. Housing prices took another spike. We know housing has been going up a lot. We got a spike in May that fed into the June CPI numbers.
Yep.
So those are the three main things right now.
Has there been any relief? I think we've seen gas prices come down a little bit and maybe inventories build up a little bit.
Yeah, you said it last night. I think we were 36 straight days of gas prices coming down. I
Yeah,
mean, that helps.
that's good. Yeah, and I think there was news that broke this morning that Russia, Ukraine announced a deal to release some of the wheat and be able to sell food again. So hopefully some relief there on that Eastern European front
Yeah,
that we could see, this inflation news, start to ease up.
yeah,
So
it won't. The wheat deal won't affect energy directly, but it does give some hope that they could speak to each other
yeah,
and maybe work out a deal that could cause energy prices to drop even further. We have seen energy dropping in the form of the Texas crude, when I believe it's Texas crude, went from $125 a barrel to $95 a barrel in the
hmm
last 30 days. As we already talked about, gas prices have crept down. They never seem to come down as quickly as they go up, but they are coming down, so we're getting some relief there. So all those things should start feeding into the inflation numbers. They haven't yet. They were not in the June numbers, but they should be baked into the July numbers. As you mentioned, we're seeing not manufacturing inventories starting to creep up. Typically, that's a bad sign for the economy because everyone assumes we are producing at the same level. So if inventories start rising, it means we're not selling as much. In this case, it's a different scenario. We're producing the same level, we're buying at the same level, we're just finally getting it through the supply chain. So that's a
yeah,
good sign as
good.
well. So, and the third factor is we actually see with the Fed raising interest rates as aggressively as they have, housing is now starting to cool off a little bit. So the three of the major factors of inflation are cooling off a little bit. So that does bode well for the rest of the year. And it goes into why LPL Research is now thinking by year end, by December, the inflation number should be coming in around 6.5%.
Okay, that's good. And then more relief in 2023, where I think they're projected between 3.5 to 4 as of right now, which will
Yeah.
be certainly some relief. So how has
Yeah.
inflation impacted the stock market? Markets have been down, markets have to adjust. How's inflation impacted the stock market this year?
Sure. It's a perceived economic domino effect. The consumer is 70% of the US economy. So if prices and everything go up, we're going to assume the consumer is not going to spend as much money. If the consumer is not going to spend so much money, corporate earnings are going to drop. Corporate earnings drops, stock valuations drop, and therefore the stock prices drop. Now, so far, the consumer is very strong. They're at all-time highs or all-time lows in debt, all-time highs in savings, and
hmm
their spending has been pretty consistent. It's not really been affected too much by inflation, at least not dramatically across the board. Now, if
Right.
inflation continues long term, it will affect the consumer, but for now, it's not had a massive effect on the consumer. But those fears of that domino effect is why the stock market has dropped so much in the past 6 months. From peak to trough, peak was what, December 27th, I believe,
Yeah.
to June 16th. The market is down 23.3%. Yeah, not
Now,
fun, not good when you open your statements and see
no,
that, but yeah,
no.
that hurts.
Now, 23.8%, I think, I just grimaced at that. If we think about past experiences, one not too long ago, COVID, February
Mhm.
19th to March 23rd, I think the market dropped over, and we say the market, S&P 500, dropped over about 32 to I think 35%
Yeah, I
in
think it
just
was
those
32.5%.
4 to 5 weeks.
Yeah. Yep.
Historically, are we somewhere in the same range? Are we worse off
Mhm.
the 23.3%, or are we better?
Well, clearly 23.3% is less than 32%.
32,
So from
right,
that
right.
perspective, we're better. I don't know if you can compare the two. That market was driven more on fear, COVID. We had no idea what we're in for, what is the world ending. That was a little bit different. Where we're the same is the typical bear market when we're not having a recession. So we're not in a recession right now. We don't think we're moving into recession. Recessions are typically defined as 2 or more quarters of negative GDP growth. We might get that, but it's also that coupled with rising unemployment, which as of right now, there are no signs of unemployment rising. So we're saying no recession, bear market. Typical bear market in that scenario is down. There's been 10 of those since 1950. Of the 10, they've been down an average of 23.1%, I believe.
Okay.
So we're
And
right on that.
how long has that drop really happened? That first drop I talked about was only about 4 weeks. Are we in that time? Are we accelerating? Is it still some time? How long does that drop take from
Yeah,
peak to trough?
it's actually 23.8%, excuse me.
Okay.
And from peak to trough on average is about 7.1 months. If
Oh,
you look
okay. And
at the 10, if you look at the 10 and look at the median one, the one right in the middle,
yeah.
5.8 months.
So 5.8 months sounds like it would be almost June 16th
It
of
would be December
2022.
27th to June 16th is right about 5.8 months. Yes.
It's funny how those numbers kind of work out and how history tends to repeat itself, where we see trends here. So since June 16th, today's about July 22nd, late July.
As we're
The
recording
market's
it.
actually bounced back a little bit. It's been up about 8% from that
Mhm.
bottom. If I have to continue to think about this, where are we going to be 3 months from now, 6 months from now, 12 months from now? I know we can't quite predict, but historically, what have we seen when we hit that bottom? What do we see over the next 3, 6, and 12 months?
Well, a couple of things. One, historically, when we had that bear market where it's down on average 23.8%, excuse me, the 12 months following has been up 7 out of 10 times, and on average is up 14.8%. So as you mentioned, we're already up about 8% off of that bottom. The average bump up over 12 months is about 14.8%. So
Okay.
that's a good
All right.
sign for what's to come. A couple other good signs for what's to come is where we are in the political spectrum. The worst period of time during a political cycle, the 4-year election cycle, is from January 1st to November 1st of a midterm election year. Think about the reasoning. It makes sense. Markets hate uncertainty. And we know typically in midterms, the pendulum starts to swing the other way. Doesn't matter which direction, it just usually there's a change. So the
Yeah.
markets are unsure about uncertainty. What are the rules for our regulations? What are our tax rules? How will the environmental rules change? So there's a lot of uncertainty. Once we get to the election, uncertainty kind of goes away and the market booms. On average, the 12 months following a midterm election, going all the way back to 1950, there's never been a 12-month period where we had negative markets. And on average, regardless of which party, which way the pendulum swings, we're up an average of 14.5% the 12 months following a midterm election. So a
Okay.
couple of good things boding for where we're headed.
So it doesn't quite matter if you have that, like you said, the Democratic president and the Republican Congress, or a Democratic president and a Democratic Congress. It's really
Well,
about certainty.
yes. I think, let me see the numbers. Democratic president, because obviously that's the only scenario for this midterm.
Yep.
Republican House
Congress.
and
Yep.
Congress, House and Senate. Markets are up average 16.3%. If Democrats hold everything, they're up. The markets are up average 10.1%. And if we have a split House and Congress, the markets are up average 13.6%.
Yeah.
So either way, it bodes well for the 12 months following November.
That's awesome. That's excellent.
Mhm.
Excellent. So we talked about the stock market. We kind of see some impacts there, or what we think could happen later on this year. Talk to us about the bond market. It's the other area that a lot of our clients are invested in, whether it be municipal bonds or corporate bonds or treasuries. What's happened in the bond market this year?
So I learned a new phrase the other day. It's TINA. Now, this industry loves their acronyms like FANG and so, but I heard TINA. You have any idea what it stands for?
It's not my Grandma Tina. So
Nope.
let's try something different.
There is
Uh,
no other alternative. There is no
uh,
alternative.
there is no alternative. Okay,
So
not Grandma Tina. Okay,
no. So
all right.
basically, what it's saying is, and it's really been the story this year. There's been no place to hide from this market. Stocks are down 23.3%, which is pretty much right on a typical bear market without a recession. For
Yep.
as bad as the stock market's been, it's been a historically bad bond market. So
Uh, sorry,
bonds,
go
if
ahead.
we allocate bonds into a portfolio to try to buffer a drop in the market,
Mhm.
bonds are down too, and there's really nowhere we can hide from that. There's no other alternatives.
I mean, you think our one partner last night mentioned a statistic that the bond market last year, we think about the bond market as the Barclays Ag,
Mhm.
was down about 1.5%, I think was the stat he gave last night. And so far, year to date, it's probably right around down 10 to 11%.
Yeah.
So you just talk about historically, we also looked at how many years the bond market's been down in total, and it was about four. So we're going to have about 2 years of and really unprecedented type losses in the bond market.
Mhm.
There's, if there's no alternative, um, what about cash? Do we talk about cash? Because isn't that an alternative? What happened there?
From a wholesale perspective, not really. I mean, think about it. We just said that June inflation numbers were 9.1%. 9.1% inflation means if you're seeing cash, you're seeing your purchasing power drop by 9.1%. If we ever do anything that guarantees you a 9.1% loss, you probably should fire us.
So, I mean, cash certainly has a place, but I think when you're invested in the market to sell out to go to cash, that may not be it. And that
On a
really brings me,
wholesale basis, yes, absolutely.
and that
Little
and that
tiny
really
tactical
brings us
moves,
to
not a big deal.
yeah, and I think that really brings us to our next point about, when we think about time horizon and planning for the future and long term or short term.
Mhm.
You've heard it from us, maybe whether it be in an email or just one-on-one chatting, but staying the course. I think staying the course means one thing, but it sounds to you maybe something different. So what does staying the course mean to you? And maybe I can chime in off of
Sure. I mean, I think what the client hears when they hear stay the course is do nothing.
that.
And that's not really what we mean. Truthfully, because we know the client, when they hear stay the course, they hear do nothing.
Yeah.
I think what a better phrase would be that would hammer it home better is stick to the plan.
Okay.
Every one of our clients has a plan. We come up with a plan with them. It's a long-term plan. And we make those plans with the idea that there will be good times, but there'll also be rainy days. And the plan is designed specifically to withstand those rainy days, just like now. So when we say stay the course, we're talking about stick to the plan. From an investment perspective, there are things that can be done behind the scenes, tiny movements to help get a little bit of extra return.
All right. And, we just had, as a firm, we have an investment committee
Mhm.
that I'm, lucky to be a part of. And we have five partners, including you here, Shane, that are part of it. We just had that meeting last week. And I would love to be able to chime in and talk about what are those changes we've made.
Go ahead.
And again, it's not staying the course doesn't mean doing nothing. We've done a lot this year.
Mhm.
Earlier in the year, we came in and we favored U.S. stocks over international stocks, and that's paid off. International stocks have had a very rough time with Russia and Ukraine and China lockdowns.
Mhm.
We favored stocks over bonds, in general, and we used some alternatives as well. But every single quarter we meet. January, we meet in April, and we met in early July, and we make adjustments. In January, we added large value to the portfolios, a specific allocation to large value. In March, we added bank loans. February and March, we added some bank loans. In the meantime, when the markets have been down, we tax loss harvest portfolios that were non-qualified, meaning non-IRA or non-retirement.
Mhm.
Losses have value, and we can get into that. Probably do another 15 minutes on tax loss harvesting in another video.
Yep.
We're adjusting and making changes along the way. But more recently, we had our July meeting, and we decided to free up some money and put into what we call dry powder. And where we did that was adding or taking bank loans and freeing that money up. And can you talk to me, Shane, about why we did that? I mean, it sounds like we just talked about cash. There is no alternative. But why do we talk about freeing up a little bit and
Yeah.
now putting it into cash?
Yeah. So it's a small tactical play. Bank loans, we put them in earlier in the year. Bank loans are something that has a little bit of an interest rate protection. As interest rates go up, your bonds go down. However, bank loans are a type of bonds that are not as negatively affected by rising interest rates. So that's why we put them in the portfolio to begin with.
Yep.
However, we think they ran their course. The spreads between bank loans and regular bonds have shrunk to the point where we're not getting rewarded for being there anymore. So secondly, we feel we may be moving into an environment where bank loans don't really perform as well. So we
So
moved out
longer
of bank
term risk.
loans. Mhm.
Sorry, there could
Yep,
be some longer term risk there that, it's performed what we needed it to do. Now we make that tactical change to position you guys better for a rebound.
right. So the question is, okay, we move out of that. Where do we put that money? We rarely do this, but in this case, we decided to hold it in cash as what you termed as dry powder. Where we wanted to move it is the stock market. When the market's down like this is like the blue light special at Kmart. This is when you can buy all the stocks cheap. So this is a great time to buy stocks. But what we need to see to feel more confident in the stock market is we need to see that inflation number peak and clearly start declining. So we decided that instead of moving into instead of moving into stocks today, we're going to sell out of the bank loans. Again, 3, 4, 5% of the portfolio, move that money to cash, hold it for now, see where inflation starts going. And once we get a clear sign that inflation is beginning to come down,
Yep.
we'll then deploy that money into probably small and mid cap stocks because those are the areas that typically do the best in the cycle we're in right now.
Okay. All right. So staying the course, making, minor adjustments along the way, but not blowing up the plan and totally changing it.
Correct. That's a great point, Dominic. But I want to go back and touch on something else you said. You talked about, or you mentioned tax loss harvesting. That's a big part of where we add value by staying the course. Tax loss harvesting, real simple concept. If you have the ABC mutual fund and it drops $20,000, we can sell that ABC mutual fund and buy the XYZ mutual fund, which basically invests in the same way. We didn't change the portfolio. We didn't change the risk characteristics or the return potential, but we then took that $20,000 loss and transferred it to a bank. We have it in a bank now, a banked loss. And we can use that because it has intrinsic value. So when the XYZ fund starts recovering with the rest of the market now, and we may have future realized gains, we can use the money in that bank, those losses, to offset those gains. So that basically turns all of those gains tax-free until we exhaust the bank. If we use them to offset some gains, and then we hit the end of the year, we can use up to $3,000 of those losses to offset income. So it becomes a $3,000 tax deduction. And then lastly, if you still have money left over in the bank, you don't lose the money. It carries over to the next year. So we can use it to offset future gains. Going back to, if people remember, 2008, we harvested enough losses with that huge market decline that people were able to wipe out the tax ramifications on their realized gains for years to come.
Yeah.
So it's something we've already done 2 cycles of it this year. Knock on wood, I hope we don't do it again because it means
No,
the market doesn't recover. But
I
if the
don't love
market
doing
does
it.
drop again, we'll do it again. But for now, we have 2 cycles of loss harvesting in. And I think from a tax perspective, we're in really good shape. Just another way we add value. We call that maximizing after-tax returns or after-tax alpha.
Alpha. All right. That's excellent. Very good. Yeah, I think we've covered a lot here today. I think what would you say are the main themes? Inflation's high, but maybe seeing some relief.
Yeah, the story of the year has been and will remain this year, inflation. So we think inflation is peaking or close to peaking. We think the second 6 months of the year, we're going to find a trend of inflation coming down.
Mm-hmm.
If that trend starts in July, great. We think we hit the bottom and we should be 8% up already and continuing to go up. If we get a couple surprises in July and August, and inflation doesn't really clearly show a peak and a downward trend until September, October, we may test the bottom again. I want to be shocked to see if we test that 23% down bottom. I don't think we're looking at an environment where we're going to go down much beyond that. I think that that's kind of a floor right now, barring anything unforeseen happening.
Right.
But based on the information we have now, if inflation shows a peak in July, I think the bottom's in. If we show inflation creeping up still a little bit in July and August, we may test that bottom of 23% down and then start the recovery.
That's great. I think if I think about our themes and everything we've talked about today, I go back to let's stay the course, right? We've made, we're going to make the adjustments.
Stick to the plan. We're going to stick to the plan.
There we go. Stick to the plan. I love it. Any other things that come to mind? I think it's been a tough market. It's been challenging, but we stick to the plan, and we're going to be able to weather through this.
Yeah, I think
weather. There you go. Full circle. It was hot. It's been hot all week. Weather through this. So.
Yes. Okay. Yeah, I think the only other thing I'll say is that there's a lot of information we're putting out there that's general. If you want to talk about how this specifically affects your account, or more importantly, how this specifically affects your plan, give us a call. Let's schedule a time to talk. Come into our office, do a phone call, do a Zoom meeting like this, whatever you want to do. We can definitely take all this information and bring it into focus with your specific plan. All right, so thanks, Dom. I think this is great. I think we got a lot of positive feedback on the last video we did. Hopefully get some positive feedback on this video, and we keep doing these. I enjoy it.
Yeah, thank you, everyone. Have a great rest of the day.
Yeah, take care. Thank you.
The opinions voiced in this video are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and may not be invested into directly. Securities are offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and FPA Wealth Management are separate entities from LPL Financial. Any outside guests spotlighted in this video and their company are not affiliated with or endorsed by LPL Financial, Private Advisor Group, or FPA Wealth Management.